recommendations by a Reserve Bank of India panel last Friday, which talked about how banking licenses can be given out a little more easily, have really seen a storm of responses. Now, important to remember a couple of things. First of all, these are a set of recommendations only at this point by an internal working group of the Reserve Bank of India. The Reserve Bank of India, as is practice, has put out these recommendations in the public domain, by which time people can give their opinions and comments on it. The time for that is up to 15th of January. And after that, the Reserve Bank of India may take a call on accepting some or all or none of these recommendations. Nevertheless, it has caused quite a bit of excitement. And here is why. Because it proposes, in part, to make it easier for large corporate houses to own and run banks. That has been a Lakshman Rekha which the Indian banking system has not crossed until now, so to speak. There's always been a fear of corporates running banks. And this has led to a number of responses and debate. The latest very key voices joining that debate, in fact, are former RBI Governor, Dr. Raghuram Rajan, and former RBI Deputy Governor, Dr. Viral Acharya, who have co-authored a note raising serious concerns about these recommendations. Now, what is all the hullabaloo about? Let's first understand what has really been recommended and why it's raised so many hackles in one quarter and celebrations in the other, especially for NBFCs, etc. To explain all of this to us, I'm joined now by Mr. SS Mundra, who's former Deputy Governor of the Reserve Bank of India. Mr. Mundra, thank you so much for speaking with us here on the India Development Debate on a very contentious and interesting subject. I want to start by asking you your view on these recommendations, and are they as pointed as some of the other views that are coming out right now? Do you have any strong feelings about it?
Okay, thank you, Tamanna. Number one, I think let's start from here that what the recommendations are, and as you rightly said, this has been a subject, I think, which has been a matter of a lot of debate over a period of time. Now, the first key question is that how much banking space we have, how many new banks we want to introduce into the system, whether the existing banking, the which are available adequate or not. But anyway, keeping that aside, I think the key question is about the entry of the corporate houses to permit it in the banking system. And I think, as you rightly said, that is what which has caused the maximum excitement. I would first put it like into two. Number one, yes, it has a kind of allowed a foot in the door, but I think allowing a foot in the door and then they be able to really enter into the room and cross it to a substantial distance, I think these are two very different things, if I can put it like this. You rightly said we should also remember this is an internal working group. These are only the recommendations, and obviously if whatever is recommended has to really fructify, then it would need other players to come into the play. And why, I'll just explain in a moment. So that is the one part of it. As far as the my take is, as far as the excitement is concerned, it would be something like this. Immediately there is an excitement, then the realization start dawning in, and then there is a more, informed assessment of the situation. Now, why I am telling so? If you read the recommendations carefully, I would put these recommendations, overall recommendations. I am not only talking about this particular recommendation. Some of them are really good. They were needed long time. Some of them are good, but how much they are doable, there is a question mark to it. And frankly, there is a third set of recommendations. To my mind, they are quite confusing, to me at least. If we have the time, we would discuss about some of those things. But if you look at this particular recommendation, so first recommendation is that the entry of corporate houses, can be considered in the banking system provided number one, there is a enabling amendment in the legislation, and that is the Banking Regulation Act. That is one thing. And second thing is that the supervisory capacity of the Reserve Bank of India should be scaled up, and because these will be typically the conglomerates, so there should be consolidated supervision. Now, what is the number one, how much the scaling up of supervisory capacity of RBI is needed?
Yeah.
As it is, banking system has expanded in recent years. Already new players have entered, new category of banks have also entered. So this is something which does not happen overnight. It takes its own normal course of time. That is one. And when you talk about consolidated supervision, it means other regulators come into the play. And when the SEBI may come into the play, the insurance regulator may come into the play. So they all come into the play. A framework of consolidated supervision has to emerge in a conglomerate, which is the primary player, whether is a banking is a primary player or an insurer is a primary player.
If I may, so right now you're talking about how there may be many hurdles for this to actually fructify. These are only recommendations. You have to wait and see whether it will happen. Keeping that aside, what is your response to the strong reactions that have come about? Because there already are so many responses as if these are happening. And I just want to quote from the Rajan and Acharya, piece that they have put out, post that they have put out, where they say the rationales for not allowing industrial houses into banking are then primarily two. First, industrial houses need financing and they can get it easily with no questions asked if they have an in-house bank. The history of such connected lending is invariably disastrous. How can the bank make good loans when it's owned by the borrower? There are some serious concerns that they have raised about the presence of corporates in the banking sector. They ask, why now? Have we learned something that allows us to override all the prior cautions on allowing industrial houses into banking? For the layperson, please explain why such a big concern. Because when it comes from Dr. Rajan and Dr. Acharya, who's saying that this sounds like a bad idea, it's important for us to understand why the concern.
Yeah, see, concern is, I think it is already indicated there. There is always a concern about the connected lending. Okay, then too much of centralization of financial muscles into certain entities, the malpractices which can, come into the system. Generally, those are the concerns about the corporate sector being in the banking, and is not unique to India. Globally, is a mixed experience, and there are many jurisdictions which don't allow. Even a jurisdiction like USA, corporate houses entry in a banking system is not available like that. So I think the recommendation itself is giving that maybe that the crux of the recommendation is that India need to grow. There is a need of much more credit. If we have to grow, we have to attain the GDP rate, which can be double digit or near double digit, and the economy reaches to a particular size of GDP. I think those are the things. But to my take is that to achieve that kind of growth, India has remained on the bank-led growth for quite some time. But the segment for which we are talking about, that the credit should be available, and to consider that this credit would only can come from the banking system, and for that banking system has the new players and the people who have the capital and who have the experience. To my mind, in today's context, this is a really, I would say, this is an argument which does not hold good. Actually, what is more needed for this purpose is to develop the alternate mechanism of this such credit being available, and market being the one of that, and then we come back to that old debate about the bond market. So yes, I agree to some extent that the development of bond market, which has been a matter of discussion for quite some time, a lot of things can be done. Rather than focusing on all that, we are trying to open a new chapter, to my mind, which is not a priority at this point of time.
Sir,
and
again,
and
sir, again, you are treading very carefully. It's not just that it's not a priority or can we do something first. Here, very serious concerns are being communicated over the very idea of corporates getting a larger foothold into the banking space. Why do you think that is the case? Is it
no,
because the past experiences,
yes, yes, I was coming to
with
that.
corporates in
I
the banking space,
Yes, yes,
they've not really covered themselves with
no, no,
glory?
I was coming to that. We all know, and it does not need any validation, that past experience has not been very great about it. But truth always lies, past cannot always be a guide for the future. So while the past experience was not very great, but it was also a given that the technology, the data availability, the capability of a supervisor, all those things were also in a much primitive shape. Today, the technology, the availability of data, the supervisory bandwidth is quite different from what it could be. So I am not telling, I won't go completely for that argument, because there had been mishaps in the past. This will be a reflection for future. That is not always true. Things can change on both sides, on the side of players and on the side of umpires, which is the supervisor. So this can change both. But my point is that looking to the factors which I have mentioned, probably there are other priorities which should engage the attention. And interestingly, if you look at the recommendation, just following that recommendation, where it is telling that the NBFCs which are above a particular size can be considered for converting into a bank. And report itself says that some of these NBFCs are owned by the corporate houses. Now, this is where I said I am confused. If that can be done, then you have the similar those requirements, the BR Amendment Act, and also the supervisory bandwidth and the consolidated supervision, because some of these NBFCs may be coming from the conglomerate where there are other activities. So actually, there is a disconnect to my mind even between these two recommendations. That is why I said, yeah.
So, I want to again ask you about the timing. This is a question that has been raised in the Rajan Acharya note as well. That why now? Why now, when the Indian banking system is anyway going through its own stress and sets of stresses? You've had, some banks go into a very precarious position. Lakshmi Vilas Bank is only the latest in that. You have the ILFS situation. You had, a whole series of, I would say, mishaps in the banking system. Is this the time to allow corporates in? They have questioned the timing and raised some pertinent questions. What do you make of the timing? And is the timing a key factor and a key question at all?
No, see, as I mentioned, see, I can't read into the mind of the group why they have recommended, but I can make certain assumptions. Assumptions could be, yes, there had been a difficult period, but now it is the time when India is looking for a higher GDP growth, for reviving the manufacturing sector, for reaching a certain size of GDP, and it would be needing the credit. And we have had the experience. There had been shadow banks coming from the corporate houses which have been operating and which have been under the regulation for quite some time. Even the regulation and supervision for these entities have been harmonized to some extent. So, there could be argument on both sides of it. But my point is, even if I take it for it that these recommendations, not going into the debate whether time is right or not, but by the very construct of recommendations, even if they are accepted as they are, which I don't expect that it will go without any reflection and thinking, but there are certain prerequisites for these recommendations to be followed even by the group, and that is something which is going to take its own time. So that is why I am telling, to my mind, the question of timing becomes irrelevant. Because what is important, if you look at the terms of reference of this group, the terms of reference itself was including the point whether the entry to the corporate houses should be permitted. If I recollect correctly, you can correct me if I am wrong. But it was a terms of reference. So when a group is given a term of reference, obviously they have to, deal with that term of reference.
Do you think that it is ideal and necessary for increased participation of corporates in the banking space, especially when the government wants to move towards further privatization of public sector banks?
Right. So that's why I said that whether how, even if you open up, how much space is there for the new players to enter, and we have seen in the past also. Now the license is available on tap. So and it's not necessary that the new players would only be coming from a one particular segment of the economy. So I think the important point at this point of time is you have the several entities which can do with a maybe change or mix of ownership, and there would be players who would be available to do that kind of thing even without any change into any regulation or any other framework. So I think focus can go on that, which can give some immediate result. And again, I would repeat, focus must go on to enhance the market mechanism, which will be very, very important for the kind of credit availability and kind of the recipients of credit which we are talking about.
Yeah. Two very clear and straight questions, Mr. Mundra. One, what do you make of the scathing tone of the letter from Dr. Rajan and Dr. Acharya? It really, there's no words which have been minced. And in your view, do you think that these recommendations will actually see the light of day in the form they are in right now?
See, on the first question, I think every thinking person would have his or her view, and I think it would not be fair for you to ask and for me to offer a counter view on the views of very learned colleagues and who have been player, who have seen the system from inside. It is not a comment from the sitting in the audience. So I think. That would not be a correct thing to say. But as I mentioned in the past, only word which I would say, history is not always a pointer for the future. But yes, everything, circumstances do change. But whether they have changed to the extent, I am not convinced. I am not convinced that they have changed. They can change in future if there is a determined effort in that direction. But clearly, they have not changed today to that extent. To that extent, I agree. That's the one point.
The recommendations about, and I'll mention two, about run large NBFCs being allowed to get licenses to convert to banks, and of corporate participation in banks.
See, about large NBFCs, as I mentioned, that this is one recommendation which I found slightly confusing, because if these are the many of these large NBFCs, if they are coming from the same system, then whether the recommendations which are in part 1 about the amendment in BR Act and the consolidated supervision would equally be applicable. So I don't know how these two things can be separated. Now, if you sort out the NBFCs, which are presently not governed by those recommendations or those requirements, then maybe there could be one or two or few players, and I think it will make eminent sense to convert them into the bank.